Let's move forward to look at calls. We're going to start out by using the following options contract. 1. ABC October 50 call at 6. Remember that this option has two parties involved, the holder and the writer. Let's look at what the different rights and obligations are for the holder versus the writer. The holder has the right, but not the obligation, to buy a fixed amount of stock, in this case 100 shares, at the strike price, in this case the strike price is 50, until the option expires in October. This is a right for the holder, not an obligation. They don't have to do it. When the holder buys this contract, they pay out the premium. In this case, the premium is $6 per share times 100 shares for $600. The holder must pay this premium no later than T plus 1 business day, 1 business day after the trade date. When the holder buys this call, what is his or her market expectations for the market's direction? They want the market to go up. The higher the better. Pick up the call, because when the market goes up, they always know that they can buy the stock at the strike price of 50. So the higher the market price of ABC goes above 50, the more profit, intrinsic value, or in the money the customer's contract is. So what is this the holder's maximum possible gain? Unlimited. Why? Because the stock can rise by an unlimited amount in theory. What is the holder's maximum possible risk? Well, if the price goes down, the holder will not exercise this contract, and what will they lose? They will only lose the premium. And what is the premium in this case? $600. So the MAC loss would be $600, the premium paid. And what is the holder's break-even point? Remember that the holder pays out $6 per share times 100 shares in order to own this contract. So how much does the price of the stock have to rise above the price of the strike price in order for the holder to recoup the $6 premium they paid out times 100 shares? The answer is 56. The strike price plus the premium is the holder's break-even point. So let's look at what would happen if the price of ABC stock rises to 75, $25 above the option strike price. In this case, the holder will want to exercise. Remember that when the holder bought this option, he or she paid out premiums of $600. When the holder exercises the options contract, he or she will buy the stock at $50 and be able to immediately sell it at $75. That yields a $25 gain times 100 shares for a total of $2,500 gain. So on this stock transaction, when the holder exercises the option, they make $2,500. But the holder had to pay out $600 in order to own this contract, so the gain on this transaction is $1,900. Remember, there are two parties involved in each options contract. So now let's look at the seller's perspective, or the writer of this same options contract. The seller or writer of a call is obligated to sell a fixed amount of the underlying securities, in this case 100 shares, at the strike price, in this case $50, when the holder exercises the contract. This is an obligation for the writer. They have to do this. So what is the writer's market expectations? They want the market to stay flat, consolidate, or if anything, go down. If the writer of this stock is not exercised, he or she will get to keep 100% of the premiums received, in this case $600. That represents the writer of a call's maximum possible gain, the total premium received. So what is the risk for the writer of a call options contract? This all depends on whether or not the writer is covered or uncovered or naked. If the writer of a call is uncovered, this means that he or she is unprotected against losses in that options contract for that call. And their maximum possible loss on this option is unlimited. Because if the market price starts to go up, let's use the scenario we used before from the point of view of an uncovered writer of a call. In this case, the market rises to $75. As the writer of an uncovered call, you have received 100% of the premium, so you took in $600. You received that. When the market price of ABC rose, the holder exercised the contract and you were forced to sell the stock at $50. Do you currently own the stock if you are uncovered? No, you do not. That means you have to go out in the market and buy the stock at 75 and then sell it at 50. If you bought the stock at 75 and then sold it at 50, you've lost $25 per share times 100 shares, you've lost $2,500. But part of your loss can be offset by the $600 premium you received when you wrote the option, leaving you with a net loss of $1,900. What is the break-even point for the writer of this call? For the writer of an uncovered call, the break-even point is equal to the strike price plus the premium. Let me explain this. Remember that as the writer, you take in 100% of the premiums, $6 per share times 100 shares. When are you going to lose that? When the market goes up and the holder has the incentive to exercise the contract. So if it goes up $6 above 50, the option strike price, the holder will exercise and you will have lost $6 per share on the stock transaction to offset the $6 you took in when you wrote the options contract. So just to repeat, the break-even point for the writer of an uncovered call is equal to the strike price plus the premium, 50 plus $6. Let's look at the writer of a covered call. Being covered meaning you own the shares. You own the shares against the underlying options contract. So what does owning the shares mean, or what does being covered mean? The writer is obligated to sell the stock when the holder exercises, right? So what will cover the writer or protect the writer against the loss on the options contract? One, owning the underlying shares. If the writer already owns the underlying shares at a price equal to or lower than the option strike price, then he or she is covered. Two, owning a convertible security, either convertible bonds or a convertible preferred stock that the owner can convert into the underlying common stock. And three, being long a call at the same strike price or lower, same expiration date or longer. How does this cover you? Because when you are exercised as the writer of a call and forced to sell the stock, if you are long a call, you can then exercise that call, buy the stock to deliver. So there are three things that cover the writer of a call. One, owning the underlying stock. Two, owning a convertible bond or convertible preferred stock. And three, being long or having bought a call at the same strike price or lower, or same expiration or longer. Note that cash does not cover the writer of a call. Why? Because the writer faces an unlimited potential upside risk. Let's look at the scenario we looked at earlier from the point of view of a writer of a covered call. Remember that in this case that the customer writes 1 ABC October 50 call at 6. In this case, the customer already owns 100 shares of the stock, originally purchased at $20 per share. The stock rises to 75, and the option is exercised. Let's look at the gain or loss on this transaction. When the person who wrote this call, the person took in premiums of $600. The option was exercised. The writer is forced to sell the stock at the strike price of 50. But does the writer have to go out in the market and search and buy the stock at 75? No. The writer already owns the stock at 20 because they bought a call at 20. The writer already owns the stock at 20. So they sell it at 50, having bought it originally at 20. They have a gain on the stock of $30 per share times 100 shares. That's a gain on the stock part of the transaction of $3,000. Plus the writer took in $600 in premiums, yielding a total gain of $3,600. What is the maximum potential loss for the writer of a covered call? Remember that the writer owns the stock, in this case at $20 per share. What is the worst thing that could happen? The stock goes to zero. The company goes bankrupt, and if that happens, then the writer loses all the way down to zero. $2,000 of stock because they had a call at 20, it went all the way to zero, but part of the loss would be offset by the premiums they wrote when they sold that contract, right? So in this case, they received $600. So the writer lost $2,000 when the stock went to zero, but they've taken in $600, leaving them with a net loss of $1,400. And finally, what is the break-even point for the writer of a covered call? This is a bit more complicated. The key thing to remember is that when there is stock involved, with an options contract, you always calculate the break-even off of the stock's position. I'm going to repeat this. Anytime that you have an option with a stock position involved, you always calculate the break-even point off of the stock's position. In this case, the writer of a covered call has taken in $6 per share times 100 shares, $600. When is the writer going to lose that money? When the price of the stock that the writer bought at 20 starts to go down or fall. So the break-even point would be the price paid for the stock, 20, minus the premium, 6. The break-even point is therefore $1,400. $14 per share times 100 shares. This is going to become a lot more intuitive as you learn the T-chart, which we're going to cover in a following video. Now, options are actually a very fun exercise to do in the world of finance, and it's similar to learning a new math concept. When you get excited about something, you're learning math or, multiple division or long division or, long multiplication for the first time. It's pretty exciting. You're like, oh, I'm learning something new. So I want you to look forward to the upcoming video we're going to cover after we get through the fundamentals of options on using the T-chart, plugging in real-time examples that are going to be asked similar to how they're going to be asked on your real SIE exam. And we're going to use this T-chart method to solve options contracts. And it's what I want you to use on the day of your exam. From what I've found, it's the most effective and easy to remember way to solve options contract questions. Great job. You're moving right along. I'll see you in the next video, moving forward on call examples.